Okay, thank you, Mike. It has been 9 long and at times tense months since the Federal Reserve has cut rates. So for many, the central banker's newly announced quarter-point reduction was welcome news. But will it actually make a difference? Our friend, Chicago native and creator of the digital series Maconomics, Ross Mac, back with us this morning to help make sense of it all. Good morning to you, sir.
Good morning. Thanks so much for having me.
Always appreciate you waking up early for us. This move was much anticipated. Fed Chair Jerome Powell called it a risk management cut, and yet it left stocks closed mixed at the end of the day yesterday. So why is that?
Yeah, so one, I think you have to understand, right? A lot of times this is a double-edged sword. And so the risk management cut boils down to earlier this month when we had job numbers, right? There was a revision of over 911,000 jobs that actually were not added. And so what it's showing us is that from a job standpoint, that's starting to slow down. Unemployment is slightly starting to creep up. And so sure, we have stock market at all-time highs, but there's a gap, right? Where you're starting to see kind of people that are effectively struggling. You had Jamie Dimon, the CEO of JP Morgan Chase, also coming out saying, that other consumer, right, will say, kind of on the lower end, they're starting to struggle where they're depleting their savings. Jobs are getting a lot, it's a little tougher to actually get jobs. And so by them cutting this quarter point, and more importantly, they gave an outlook saying that they would also cut 2 more times this year, once in 2026 and another in 2027. But the outlook is, hey, let's actually do this so that the jobs market actually doesn't actually topple over. And so what does that mean? Anytime, consumers, when we see that interest rates are lower, us as consumers, that means that money is cheaper. We now have the ability to go and finance for cheaper, meaning, right, credit cards, auto loans, home loans. But the other double-edged sword, the good part of it is that one, now companies also are able to finance at cheaper levels, meaning that they might want to hire more. They can expand now.
You know what? You answered a couple of my questions there, so I'm grateful that you kind of expanded on it. The president has pushed this as something to spawn economic growth. So why do you think the Fed has been so cautious to make these cuts and to keep them going? Like you said, we could possibly see maybe 2 more before the end of the year.
Yeah, so great question, right? We haven't lowered, the Fed, Jerome Powell and his team hasn't lowered rates since last year. And so the reason that they've been cautious is, like I say, it's a double-edged sword. When you lower rates too much, right, or too fast, that can have the negative effects on the economy where you see inflation continue to creep up. And so that's kind of one of the things where you see gas prices and grocery prices being higher. If you really go back to kind of those COVID days when we saw rates being so low, the biggest thing is where we saw inflation in our lifetime being the highest. We actually saw inflation creep up over 9%. And so when you keep rates low and when money supply and, when money is so cheap, what happens from a supply demand standpoint as well? Everybody can afford it. What happens now? Prices actually have to go up. And so that's kind of the double-edged sword. I think the good thing, right, is that, the stock market and investment, so anyone who's owning assets tend to do well when interest rates are lower. But like I say, the Fed has a very delicate job where it's like, okay, let's make sure the economy doesn't topple over. Let's not have a recession, but let's not have inflation like we saw, call it three or 4 years ago.
Okay, lots to consider there. Thank you for breaking it down. We appreciate it.
Without a doubt. Thanks for having me.
All right, see you again soon.